Double taxation agreements and the elimination of double taxation in the UAE. Overview of double taxation agreements, DTAs. The UAE has established double taxation agreements, DTAs, with various countries worldwide to address the issue of double taxation that may arise when a resident person earns foreign source income. These agreements play a critical role in ensuring that income derived from international sources is not subject to taxation in both the UAE and the foreign country where the income originates. The DTAs establish frameworks and mechanisms to eliminate or reduce this burden, promoting a more favorable environment for cross-border trade and investment. Mechanisms for the elimination of double taxation. When a resident person in the UAE receives income from a foreign country with which the UAE has an active DTA, the agreement typically provides for one or more mechanisms to eliminate or alleviate double taxation. The mechanisms used may vary based on the type of income involved and the specific terms and provisions contained in the relevant DTA. The key methods provided under DTAs include 1. Exemption method. Under this approach, the income earned from a foreign source is exempt from taxation in the UAE. This means that the UAE does not impose any corporate tax on the specific foreign source income, regardless of whether it was subject to tax in the foreign jurisdiction. 2. Credit method. With this method, the UAE resident person may offset the taxes paid in the foreign jurisdiction against their corporate tax liability in the UAE. In practice, this means that any tax paid abroad on the foreign source income can be credited against the corporate tax due on that same income in the UAE. The amount of the credit typically cannot exceed the amount of corporate tax that would otherwise be payable on that income in the UAE. 3. Application of both methods. Depending on the specific terms of the DTA and the nature of the income in question, there may be circumstances where both the exemption and credit methods can be applied. The relevant methods depend on the detailed provisions outlined within the DTA, which dictate the treatment of various types of income, such as dividends, interest, royalties, and other cross-border earnings. Precedence of double taxation agreements over corporate tax law. One of the critical features of DTAs is that their provisions generally take precedence over domestic tax laws, including the UAE's corporate tax law, in cases where there is any inconsistency between the DTA and the domestic legislation. This internationally recognized and accepted practice ensures that the DTA terms prevail to prevent instances of double taxation, thereby fostering certainty and compliance in cross-border tax matters. It reflects a commitment by the UAE to uphold its obligations under international agreements and to offer a clear, predictable tax environment for taxpayers operating across jurisdictions. International context and commonality. The precedence of DTAs over domestic corporate tax law is consistent with global standards in international taxation. Many countries follow this approach to provide certainty to taxpayers about how cross-border income is treated, to facilitate international business, and to eliminate instances of double taxation that might otherwise act as barriers to international trade and investment. This practice encourages foreign direct investment, FDI, and provides a more stable framework for multinational businesses operating within or through the UAE. For more details, contact us.